market opens in 30 minutes. The coffee is already cold. The screens are already moving. Futures are shifting. Headlines are updating. Pre-market prices are jumping, fading, reversing, and pretending to make sense for about 12 seconds at a time. On one screen, a stock that looked strong yesterday is starting to wobble. On another, a sector is turning red before the opening bell. A chart shows a clean trend line. The news says one thing. The volume says something else. And the trader sitting in front of it all wants what every trader wants, even if nobody wants to admit it out loud. Certainty. Buy, sell, hold, wait, get in, get out, do something, do nothing. The market doesn't make that part easy, because the market isn't just a chart. It is earnings, interest rates, inflation numbers, global news, analyst ratings, fear, greed, algorithms, headlines, rumors, and millions of people making decisions for millions of different reasons. Very inconsiderate of them. And that's where artificial intelligence enters the room. AI does not get tired. It does not panic because a candle turned red. It does not fall in love with a stock because it had one great day. It can scan data, compare markets, look for relationships, and identify patterns faster than a human being ever could. That sounds powerful. And it is. But before we go any further, we need to be clear. This video is for education and discussion only. It is not financial advice, and it is not a recommendation to buy, sell, or trade any stock, option, crypto, ETF, fund, or investment. Markets involve risk, and AI tools can be wrong. That matters because this is exactly the kind of topic where hype can get dangerous. AI can sound confident, charts can look convincing, a signal can feel like an answer, but the market does not owe anyone a clean outcome. So, the real question is not whether AI can make a chart look smarter. The question is whether AI can help people read the market more clearly without fooling them into thinking the future is guaranteed. Because that's the tension. A human trader sees the screen and tries to make sense of what is happening. AI sees data, lots of it, price movement, trends, correlations, volume, market relationships, possible direction. Signals that may be too complex or too fast for one person to process alone. And in a world where one headline can move a stock, one announcement can change a sector, and one bad decision can turn confidence into regret, that kind of help is tempting, very tempting. But the market is not a construction plan, it is not a safety checklist, it is not a field map. It moves because people move. It reacts because people react, and sometimes it turns for reasons that only seem obvious after the damage is already done. That's why AI and investing and trading is so fascinating. Not because it gives people a magic button, it does not, but because it raises a better question. Can AI help us see the market differently? Can it help us spot patterns earlier? Can it help us organize signals before emotion takes over? Can it help separate useful information from noise? And maybe the hardest question of all, AI can read the market, but can it predict what comes next? Section 2. What AI gets right. To make this easier, imagine someone named Patrick. Patrick is not trying to become a Wall Street legend by lunch. He's trying to answer a much more realistic question. Is the market showing a trend, or is he just seeing what he wants to see? That's a very human problem. Because once someone has an opinion about a stock, an ETF, a sector, or even the broader market, it becomes surprisingly easy to start collecting evidence that supports what they already believe. A green candle feels like confirmation. A positive headline feels like proof. A pullback feels temporary because, well, obviously it's just taking a breather. Until it is not. And that's one place where AI can be useful, not because it has feelings, because it does not. AI doesn't care whether Patrick wants to be right. It doesn't care if he bought too early, waited too long, missed the move, or convinced himself that this time the chart definitely means what he wants it to mean. AI can scan data without getting emotionally attached to the answer. That matters, because markets generate more information than any one person can reasonably process. Price action, volume, moving averages, earnings revisions, interest rates, sector rotation, currency movement, commodities, global markets, news, sentiment, and all the strange little relationships that can affect one asset before most people notice the connection. A human can look at some of that. AI can look at a lot more. It can compare patterns across markets. It can help detect trend changes. It can organize signals that might otherwise be scattered across different charts, indicators, headlines, and data sources. It can help Patrick slow down and ask better questions before acting. Is this strength happening in one stock or across the whole sector? Is the broader market supporting the move? Is momentum improving, weakening, or just making noise? Are related markets pointing in the same direction or warning that something does not quite line up? Is the signal getting stronger, or is Patrick just hoping it is? Those are useful questions. And if AI helps ask them faster, more consistently, and with less emotion, that has value. This is especially important because trading and investing decisions often happen in pressure. The market is open, the price is moving, the chart is changing, someone online is very confident, someone else is equally confident in the opposite direction. Very helpful. Thank you, Internet. And in that environment, the biggest danger is not always a lack of information. Sometimes the danger is too much information, arriving too fast from too many places with too much noise. AI can help organize that. It can help turn a messy flood of signals into something a person can review. It can help highlight possible direction. It can help compare today's movement against historical patterns. It can help identify when a trend may be forming, weakening, or reversing. It can help Patrick avoid staring at one chart in isolation and forgetting that markets are connected. That last part matters. A stock does not move in a vacuum. A technology company may be affected by interest rates. A commodity stock may be affected by currency movement or global demand. A bank stock may react to bond yields. A multinational company may be influenced by foreign markets. A broader index may shift because investors are rotating from one sector into another. The market is a web, and AI is good at looking for patterns inside webs. That does not mean AI understands the future. It means AI can help organize the present, and sometimes seeing the present more clearly is already a major improvement. For Patrick, the value is not that AI tells him what to do. The value is that AI gives him another layer of analysis before he makes a decision. It can help him pause. It can help him compare. It can help him challenge his first reaction. It can help him see when the evidence is stronger than his opinion. And that is what AI gets right. It can process more data than a person. It can look for relationships a person might miss. It can help reduce emotional bias. It can organize signals into something easier to evaluate. It can support better questions before money is on the line. But this is also where the caution begins. Because a better signal is not the same thing as a guarantee. A cleaner chart is not the same thing as certainty. And a tool that helps Patrick read the market still cannot promise what the market will do next. One example of this kind of AI market tool is VantagePoint software. And before anyone gets the wrong idea, this is not a recommendation to use it, buy it, or trade with it. We are not reviewing the software. We are not saying it's right for everyone. And we are definitely not saying any tool can make the market safe. We're using it as one real-world example of how artificial intelligence is being applied to market forecasting. VantagePoint describes its software as using artificial intelligence, neural networks, and intermarket analysis to help traders evaluate possible short-term market direction. The company says its technology looks at relationships between markets, not just one stock or one chart in isolation. To create predictive indicators and trend forecasts, that idea matters because markets are connected. A stock may be affected by its sector. A sector may be affected by interest rates. Interest rates may be affected by inflation expectations. Currencies, commodities, bonds, indexes, global markets, and investor sentiment can all push and pull on each other. So instead of only asking, what did this stock do yesterday? A tool like VantagePoint is designed to ask a broader question. What are the related markets doing? That's intermarket analysis in plain English. It's the idea that one market does not move completely alone. For Patrick, that can be useful. Let's say Patrick is looking at a stock and trying to understand whether a trend may be forming. AI might help him compare signals he would not have checked manually. It might help him see whether related markets are confirming the move or contradicting it. It might help him notice when momentum appears to be changing before the chart feels obvious. That doesn't mean Patrick suddenly knows the future. It means he has another layer of information to consider. VantagePoint also promotes demos and training, which is worth noting because tools like this can be easy to misunderstand if someone only looks at the marketing headline. Training matters because a forecasting tool is only useful if the person using it understands what the signal is actually saying, what it's not saying, and how it fits into a larger decision process. Because with financial AI tools, the danger is not only whether the tool works, the danger is whether the user understands what the tool is actually showing. A predictive indicator isn't a guarantee. A forecast is not a promise. A signal is not a command. And a confidence number is definitely not a permission slip to ignore risk. That's where Patrick still has to be careful. AI might tell him a trend looks favorable, but Patrick still has to ask, what's my risk? Where am I wrong? What happens if the market moves against me? Am I using this as one input, or am I letting it make the decision for me? Can I afford this trade? Am I chasing a signal because it is useful or because it tells me what I wanted to hear? Those questions matter more than any chart, because even the most impressive AI tool still operates inside an uncertain market. It can process information. It can compare relationships. It can generate indicators. It can help Patrick think more clearly. But it cannot guarantee the next candle. It cannot stop an earnings surprise. It cannot predict a geopolitical shock. It cannot make a bad risk plan safe. That's the honest way to look at tools like this. They may help traders read the market. They may help organize signals. They may help identify possible trend direction. But they don't remove the need for judgment. And they definitely do not remove the need for caution. For Build Smarter, that's the lesson. Don't confuse a smarter tool with a guaranteed outcome. Use the tool to ask better questions. Use it to compare signals. Use it to challenge your first reaction. Use it to slow down before emotion takes over. But do not hand it the steering wheel and pretend the road disappeared. Do you know what AI still cannot know? This is where the excitement has to meet reality. Because AI can be useful. It can scan data, it can compare markets, it can highlight possible trends, it can help Patrick step back from emotion and look at signals with a little more discipline. That matters. But the market still has a talent for humbling anyone who gets too comfortable. Because AI can read patterns, it cannot control what happens next, it cannot know what a CEO is about to say on an earnings call. It cannot know whether the Federal Reserve will use one sentence that changes the mood of the entire market. It cannot know when a geopolitical event will hit the news. It cannot know when panic will spread faster than logic. It cannot know when a stock that looked strong yesterday will get crushed tomorrow because one piece of information changed the story. And it cannot know what every trader, institution, fund, algorithm, and nervous human being will do when fear or greed takes over. That is the part no tool gets to skip. Risk. AI can help Patrick see a possible setup. But Patrick still has to decide what the risk is. How much is he willing to lose? Where is the idea wrong? What would make him step away? Is he using a tool to support a plan? Or is he using a signal as an excuse to avoid making one? That last question matters so much, because a market tool can become dangerous when it makes a person feel more certain than they should be. A chart can look clean. A forecast can look convincing. A signal can look official. But none of that changes the basic truth. The market does not have to cooperate. That is why AI should never be treated like a crystal ball. It is better understood as a research assistant, a signal organizer, a pattern finder, a way to look at more information than one person could reasonably process alone. That can be valuable, but it is not the same as knowing the future. And for Patrick, that is the difference between using AI wisely and letting AI create false confidence. If AI helps him pause before acting, that is useful. If it helps him compare signals, that is useful. If it helps him ask better questions, that is useful. If it helps him notice that related markets do not support his first impression, that is useful. But if it convinces him to ignore risk because the forecast looks good, that is not intelligence. That is just a more expensive way to be reckless. So the smarter approach is not to ask AI for certainty. The smarter approach is to use AI for perspective. What is the trend saying? What are related markets saying? Where might momentum be changing? What evidence supports the idea? What evidence argues against it? What would prove this decision wrong? Those are better questions, and they are questions a human still has to own. Because when money is on the line, responsibility does not transfer to the software. If the trade goes badly, the AI does not feel it. Patrick does. If the account takes a hit, the AI does not have to explain it. Patrick does. If the lesson is expensive, the AI does not pay tuition. Patrick does. That is why the final answer has to be honest. Can AI read the market? Yes. It can help. It can scan patterns, compare signals, study relationships, and highlight possible trend direction. But can it predict what comes next? Not with certainty, not without risk. Not in a market that can change because of one headline, one report, one speech, one surprise, or one wave of emotion. The value of AI is not that it removes uncertainty. The value is that it may help people make decisions with a little more structure and a little less emotion. And that is useful, but only if the person using it remembers what it is. A tool, not a promise. A tool, not a guarantee. A tool, not a substitute for judgment. So use AI if it helps you think more clearly. Use it to research. Use it to compare. Use it to challenge your assumptions. Use it to slow down before emotion takes over. But do not let any tool, no matter how advanced, convince you that the market has become safe. Because AI can read the market, but the future still has a vote. And that is why you build smarter. If you want more real-world AI tools explained without the hype, subscribe to Build Smarter. No pressure at all.